For the first time since 1998, the United States has stepped into the foreign exchange market to buy Japanese yen, joining Tokyo in an extraordinary attempt to stop one of the world's most important currencies from sliding further. The yen had fallen to nearly 164 against the dollar, its weakest level in roughly 40 years, when Japanese authorities began buying their own currency. Then Washington joined them. Within days, the yen had strengthened by roughly 4% to 5%, forcing traders who had spent months betting against it to reconsider how far the decline could go. But the most important part of this intervention is not that America decided to help an ally. It is why a weak Japanese currency had suddenly become an American problem. Japan has intervened in currency markets before. Tokyo spent heavily in April and May trying to slow the yen's decline, including a record single-day operation worth 6.28 trillion yen on April 30. Those actions produced temporary rallies, but the underlying pressure never disappeared. By late July, the yen was again sliding toward levels not seen since the 1980s. This time, however, something changed. The United States did not merely approve of Japan's intervention from the sidelines. American authorities entered the market themselves. That distinction makes the episode historically unusual. Washington last intervened in the foreign exchange market in 2011, when the United States joined other G7 countries in selling yen after Japan's earthquake and nuclear disaster caused the currency to strengthen rapidly. Buying yen is much rarer. The Treasury's own history records that U.S. monetary authorities purchased the Japanese currency in June 1998, when Japan was struggling through a banking crisis and the Asian financial system was under intense pressure. Until this latest intervention, Washington had not repeated that specific operation for 28 years. The mechanics were also unusual. Japan bought yen by selling foreign currencies from its enormous reserve portfolio. The American side reportedly purchased yen through the Federal Reserve Bank of New York, but instead of simply selling dollars, the Treasury used euros to fund at least part of the operation. Before the intervention, Treasury Secretary Scott Bessent was photographed at a cabinet meeting with a note reading, "Buy Japanese yen," followed by an amount of $5 billion to $10 billion. U.S. officials had also warned several banks to be prepared for possible action. Foreign exchange intervention usually works partly through surprise. A government suddenly appears in the market with enough money to make traders question whether their positions are safe. Washington did almost the opposite. It signaled that intervention was possible, showed markets that the United States was coordinating with Tokyo, and then made clear that additional action could follow. That suggests the objective was not merely to buy enough yen to move the exchange rate for a few hours. The governments were trying to change expectations. For months, currency traders had a powerful reason to sell yen. Japanese interest rates remained substantially below U.S. rates, making it attractive to borrow cheaply in Japan and invest the money in higher-yielding assets elsewhere. This is the classic yen carry trade. As long as the Bank of Japan stayed relatively cautious while the Federal Reserve maintained higher rates, investors could earn the interest rate difference while also benefiting if the yen weakened. Japan's domestic policy added another source of pressure. Prime Minister Sanae Takaichi's government has favored an expansionary economic approach, while markets have questioned how aggressively the Bank of Japan will tighten monetary policy. The BOJ raised its policy rate to 1% in June but held it there at its July 31 meeting, even as officials indicated that further increases could become necessary. The gap between Japanese and American interest rates remained wide enough to keep the carry trade attractive. That created an uncomfortable cycle. Investors sold yen because Japanese rates were low. A weaker yen increased Japan's import costs. Higher import prices increased inflation. Rising inflation created more pressure on the Bank of Japan to raise rates. But aggressive rate hikes could destabilize an economy and bond market accustomed to decades of exceptionally cheap money. For years, Japan often welcomed a relatively weak currency. Companies such as Toyota, Sony, and major industrial exporters earned revenue overseas and converted those earnings back into more yen. Japanese products also became cheaper relative to American and European competitors. The weakness of 2026 moved well beyond that familiar trade-off. Japan imports most of its energy. It also depends heavily on imported food, raw materials, and industrial commodities. When the yen loses value, the country must spend more local currency to purchase the same barrel of oil, cargo of LNG, or shipment of agricultural products. The Iran war has made that exposure considerably more painful. Energy prices increased while shipping routes through the Middle East became less reliable. Japan therefore faced two price shocks simultaneously: expensive commodities and an increasingly weak currency used to purchase them. By August 10, senior executives at Mitsubishi Electric, Mitsui, Mitsubishi Corporation, and other major Japanese companies were publicly calling for greater exchange rate stability. Their concern was not simply whether the yen should be strong or weak. Rapid movements make contracts, investment planning, import budgets, and financial hedging more difficult. A weak yen can help exporters while simultaneously hurting the domestic customers those companies ultimately depend on. This is where the American side of the story begins. At first glance, Washington should have little reason to spend political capital protecting Japan's currency. President Trump has repeatedly criticized foreign countries when he believes their currencies are being kept artificially cheap because a weak foreign currency makes imports more competitive against American production. Japan was still on the U.S. Treasury's currency monitoring list in July. Treasury Secretary Besant said the administration would aggressively examine policies that artificially suppress currencies and harm American companies. Yet, only days later, Washington was helping Tokyo push the yen upward. There is no contradiction in those two actions from Washington's perspective. A stronger yen can actually help achieve several American objectives. The first is trade. Imagine that Washington imposes a tariff on a Japanese product to make that product more expensive in the United States. If the yen then falls sharply against the dollar, the Japanese producer gains an exchange rate advantage that can offset part of that tariff. A simple example shows the mechanism. Suppose a Japanese manufacturer receives 1 million yen for a product. At 140 yen per dollar, that represents more than $7,100. At 164 yen per dollar, the same 1 million yen represents only about $6,100. The company therefore has considerably more room to cut its dollar price while maintaining roughly the same yen revenue. Currency weakness can function like an invisible export discount. That matters for an administration using tariffs to change trade flows. If Washington raises the cost of Japanese imports by one route while currency markets reduce that cost through another, part of the intended protection disappears. Trump has spent years arguing that exchange rates are inseparable from trade competitiveness. From that perspective, allowing the yen to fall indefinitely while simultaneously trying to protect American manufacturers would work against part of his own trade strategy. But trade alone does not fully explain such an extraordinary intervention. The more consequential connection runs through the bond market. Japan is one of the largest foreign holders of U.S. government debt, with holdings of roughly $1.14 trillion after a particularly sharp decline in May. Reuters noted that Japan's Treasury holdings fell by almost $67 billion that month, the largest monthly decline since September 2022. That relationship matters because Japan finances currency intervention partly through its foreign reserves. When Tokyo wants to strengthen the yen, it sells foreign currency assets and uses the proceeds to buy yen. A large portion of Japan's reserves is invested in highly liquid securities, including U.S. government debt. If Japan repeatedly needs tens of billions of dollars to defend its currency, markets naturally begin asking where the money will come from. One option is selling U.S. Treasuries. That is where Japan's currency crisis can become America's interest rate problem. The United States is financing a large federal debt at a time when long-term borrowing costs are already elevated. Reuters noted that long-dated Treasury yields had reached their highest level since 2007, around the time of the intervention. Higher Treasury yields do not stay inside government finance. They feed through to mortgages, corporate bonds, business investment, and other borrowing costs across the American economy. If one of the world's largest holders of Treasury securities suddenly becomes a persistent seller because it needs dollars to defend its currency, that creates exactly the kind of additional upward pressure Washington would prefer to avoid. This helps explain another unusual part of the operation. Japan's Ministry of Finance publicly highlighted its access to the Federal Reserve's FEMA repurchase facility, which allows foreign monetary authorities to temporarily exchange U.S. Treasury securities for dollars, rather than selling those securities outright in the open market. For Japan, that provides liquidity. For Washington, it can reduce the risk of forced Treasury selling. The connection turns what appears to be a Japanese exchange rate problem into a balance sheet relationship connecting Tokyo's currency reserves directly to American borrowing costs. A collapsing yen can cause Japan to intervene. Large intervention can require dollar liquidity. Dollar liquidity can require asset sales. If those sales hit U.S. Treasuries, yields can rise. Rising yields increase financing costs throughout the American economy. Suddenly, the yen is no longer just Japan's problem. It sits inside the financial architecture funding the United States. That does not mean Washington intervened solely because it feared Japan would dump treasuries. Reuters reported several possible motivations, and officials have emphasized concerns about excessive currency volatility rather than presenting a single hidden objective. The bond market explanation is therefore best understood as a strategic incentive supported by the financial relationship, not as a confirmed secret motive. Inflation gives both governments another reason to cooperate. Japan's weak currency makes imported energy more expensive, precisely when Middle Eastern disruptions have already raised energy costs. That pressure can spread through electricity, transportation, food, and manufacturing. America faces a different inflation problem. If Japanese instability forces global capital to reposition rapidly, Or if the Japanese bond market sells off and investors begin repatriating foreign assets, the resulting moves can hit U.S. financial conditions. Japan has accumulated enormous overseas investments during decades of low domestic interest rates. Japanese banks, insurers, pensions, and investors own assets around the world. Changes in Japanese yields therefore influence whether that capital remains abroad. This is one reason the Bank of Japan's next move matters so much. Raising Japanese interest rates could support the yen by making yen-denominated assets more attractive. It could also reduce the profitability of the carry trade. But higher domestic yields create an incentive for Japanese institutions to reconsider overseas holdings. If Japanese investors can suddenly earn more at home, some capital invested in U.S. bonds may return to Japan. Washington therefore faces a strange balancing act. It wants a yen strong enough to avoid destabilizing Japan and undermining American trade policy, but it does not necessarily want Japanese interest rates to rise so aggressively that enormous amounts of capital leave U.S. markets. Currency intervention can buy time between those two outcomes. Instead of relying entirely on the Bank of Japan to raise rates, Tokyo and Washington can attempt to change the exchange rate directly. If traders believe authorities are willing to intervene repeatedly, speculative yen selling becomes more dangerous. The initial market reaction demonstrated that power. The yen moved from nearly 164 per dollar toward the mid-150s, reaching its strongest levels in about 3 months. Traders who had assumed policymakers would tolerate endless depreciation suddenly had to account for the possibility that two governments were standing on the other side of the trade. Yet intervention has an important weakness. It changes the supply and demand for currency in the market, but it does not automatically change the economic fundamentals creating the pressure. Japan still has lower interest rates than the United States. The country still imports large amounts of energy. Fiscal policy remains relatively expansionary. The government still carries an enormous public debt. Investors still have incentives to search for higher yields overseas. Unless those forces change, traders can eventually return. Japan has already experienced this pattern. Tokyo spent heavily intervening in April and May. On April 30, authorities used 6.28 trillion yen in the largest single-day yen buying operation in the official data series. The currency strengthened sharply. Then it weakened again. By July, it was approaching 164. That history explains why the latest intervention is strategically different. Japan did not simply increase the amount of money it was willing to spend. It added the credibility of the United States. The message to markets changed from Tokyo thinks the yen has fallen too far to Tokyo and Washington both think this movement has become dangerous. That can influence traders even if the actual American purchase is relatively small. Foreign exchange markets trade trillions of dollars every day. Governments generally cannot overpower them indefinitely through brute force. Intervention works best when it causes investors to reconsider whether the underlying trade is still worth the risk. Washington's participation changes the risk calculation because traders no longer know what escalation might follow. Another coordinated purchase is possible. The Bank of Japan could raise rates sooner. Japanese institutions could repatriate capital. Treasury officials could continue signaling that the yen is undervalued. Each possibility increases uncertainty for anyone maintaining a large, short yen position. But Japan cannot outsource the currency problem permanently. The latest BOJ discussions show policymakers themselves recognize this limitation. A summary of the July meeting released on August 10 showed officials debating whether interest rates may need to rise faster than previously expected as inflation risks increase. Some policymakers warned that Japan is moving from a period when the main concern was generating inflation to one where the greater danger may be allowing inflation to overshoot. That shift is significant. For much of the last 3 decades, Japan was famous for the opposite problem. Deflation, weak wage growth, and sluggish demand pushed the Bank of Japan towards zero rates, negative rates, and massive bond purchases. The 2026 environment looks very different. Imported inflation, higher energy costs, wage pressures, and a weak currency are forcing the central bank to think about restraint rather than stimulus. The yen sits at the center of that transition. If the currency remains weak, import prices stay elevated, and the BOJ faces pressure to raise rates. If the BOJ raises rates aggressively, Japan's bond market and highly leveraged economy must absorb higher financing costs after decades of extraordinarily cheap capital. If Japanese yields climb enough, international capital flows can shift. Those flows can reach American Treasury markets. This is why a foreign exchange intervention that appears bilateral can have global consequences. Japan's latest economic data underscores the pressure. Figures released August 10 showed that the country recorded its first current account deficit in 17 months in June. High oil import costs contributed to the trade deficit, although the monthly current account number was also heavily affected by a sharp decline in primary income. Japan still recorded a very strong current account surplus across the first half of the year. so one monthly deficit does not indicate a structural external crisis. But it illustrates how energy prices and exchange rates are interacting with the country's external finances. There is another contradiction beneath the surface. Japan's exporters often benefit from the weak yen, and some of the country's largest corporations earn enormous profits abroad. For years, that made currency depreciation politically manageable. The current weakness is increasingly difficult for households and import-dependent businesses. Consumers pay more for food and energy. Retailers pay more for imported goods. Manufacturers pay more for commodities. Airlines pay more for fuel. Utilities pay more for LNG. The benefits are concentrated among companies with large foreign revenues, while the costs spread through much of the domestic economy. That distribution helps explain why Japanese business leaders are now emphasizing stability instead of simply celebrating a cheap currency. Washington has its own distribution problem. A weaker yen can make Japanese imports cheaper for American consumers while hurting competing U.S. manufacturers. A stronger yen can improve American competitiveness but increase prices for some imported Japanese products. Currency policy therefore creates winners and losers on both sides of the Pacific. The United States is not intervening because one exchange rate is objectively perfect. It is intervening because the speed and scale of the movement began creating risks larger than the benefits. There is a historical echo here. In 1998, Washington bought yen when Japan's financial weakness threatened to interact with the broader Asian crisis. The circumstances today are very different. Japan is not experiencing the same banking collapse, and the global economy does not resemble the Asian financial crisis. But the strategic logic contains a familiar element. The United States becomes interested in another country's currency when that currency begins affecting the stability of the larger system America itself depends on. 28 years ago, that concern centered on an Asian financial crisis. In 2026, the transmission channels include trade competitiveness, inflation, global carry trades, and a Treasury market carrying trillions of dollars of American government debt. That final connection may be the most revealing. For decades, Japan's enormous savings helped finance the rest of the world. Low domestic yields encouraged Japanese capital to move abroad, while the country accumulated vast holdings of U.S. securities. That arrangement benefited Washington. Japan received a deep, liquid place to invest its reserves and private savings. The United States gained a huge pool of demand for its debt. A severely unstable yen threatens to complicate that relationship. If Japan must repeatedly mobilize its reserves, or if higher Japanese rates eventually pull private capital home, the flow of money that once looked almost automatic becomes less certain. The United States therefore has reasons to care about Japanese financial stability that extend far beyond friendship between two governments. The yen intervention exposed that interdependence. Washington can pressure Japan through tariffs. Japan can depend on the American security umbrella. American consumers buy Japanese products. Japanese investors finance American debt. The Federal Reserve provides liquidity facilities that can help Tokyo avoid destabilizing Treasury sales. Each country holds a different form of leverage over the other. The immediate question is whether the intervention will hold. The yen initially recovered sharply, but has already shown signs that the underlying pressure has not disappeared. Analysts continue to argue that lasting strength probably requires changes in monetary policy, fiscal expectations, or capital flows rather than intervention alone. Tokyo and Washington can punish speculators. They cannot permanently repeal the interest rate differential. They can provide dollar liquidity. They cannot eliminate Japan's dependence on imported energy. They can signal that 164 is unacceptable. They cannot dictate indefinitely where the market believes the currency belongs. But intervention does not have to solve every problem to succeed. If it gives the Bank of Japan several months to adjust policy gradually, prevents disorderly selling of Japanese bonds, limits imported inflation, and reduces the probability that Japan must liquidate large quantities of U.S. Treasuries, it may accomplish something strategically valuable even if the yen never returns to the levels Tokyo once considered normal. That is why Washington's decision matters more than the number of yen purchased. America crossed a line it had not crossed since 1998 because the exchange rate had moved beyond a Japanese domestic issue. A weak yen was affecting trade. It was feeding inflation. It was threatening financial stability. And behind the currency market sat another market Washington cannot afford to ignore: the market financing the U.S. government itself. Japan needed help stopping the yen from falling. The United States discovered that allowing it to keep falling carried costs of its own. That is the hidden leverage inside this intervention. The dollar gives Washington enormous financial power. But the global system built around that dollar also depends on foreign governments and investors continuing to hold enormous quantities of American assets. Japan is one of the most important of those holders. So when the yen approached 164 and Tokyo began defending it with tens of billions of dollars, Washington was not simply rescuing an ally's currency. It was helping stabilize a financial relationship that runs in both directions. The intervention may prove temporary. The yen could weaken again, and the Bank of Japan may eventually have to make the harder decisions that currency purchases postpone. But the precedent is already significant. For the first time in 28 years, the United States bought yen. And the reason may tell us more about the balance of economic leverage between Japan and America than the exchange rate itself.